Trent Masters, Global Portfolio Manager at Alphinity Investment Management. Trent, it's been a pleasure hosting you at the Investment Leaders Forum in Oz in Byron Bay.
Yeah, no, thank you very much for having me. It's been a really enjoyable experience.
Trent, the Alphinity approach focuses on high quality companies that are in an earnings upgrade cycle. What key factors go into that definition of high quality in the first place?
Yeah, look, that's a good question because quality can be different things for different people. For us, there's very specific factors and they've all been back tested using quant for about the last 4 decades. And that's return on equity, the change in return on equity. We want to see that return on equity improving. Cash off the balance sheet. So none of this kind of accounting shenanigans. We need to see genuine cash being generated off the assets. And that fourth element is called balance sheet accruals, where normally if you see this element pop up on a balance sheet, it normally means that sometimes companies can be contorting what they're doing to generate the earnings. So they're the 4 key back-tested quant factors that we look at that defines quality for us.
With a highly concentrated portfolio of 25 to 40 stocks, how do you balance conviction and best ideas and knowing those well with the need to be diversified across sectors and regions?
Yeah, look, risk is always a really important part of portfolio construction. So for us, when we're running those risk reports, we want to see that the vast majority of the risk that we're allocating in the portfolio is stock specific. So the risk and the quant will pick up if there's too much of a country tilt, if there's too much of a sector tilt, and we will manage that accordingly. So it doesn't matter, me being the tech PM, how bullish I am on tech. There'll always be constraints to make sure that we've got an overall diversified portfolio because that's what you need to make sure you can generate long-term returns.
Trent, the first quarter of 2025 has thrown some doozies of situations at us. How do those macroeconomic and geopolitical factors influence your stock selection and how do you adjust the portfolio in response to major shifts in those? Yeah. Particularly when they can be so short-term and sudden.
You are right. It has been quite a start to the year. It feels like it's been a long year and we're just hitting April. But for us, that's why that earnings leadership piece is so important, that we're not trying to permeate an overarching macro view through the portfolio. As conditions change, you'll start to see it come through different companies in their earnings. And they'll start to beat expectations, while conversely other companies will start to miss. So that's why that earnings upgrade cycle, that earnings leadership is so central to what we do, because those macro conditions will filter through to companies and we can pick it up in the actual earnings that are coming out of these businesses and the change of expectations that is generating.
Trent, how do you integrate ESG considerations into your investment decisions? And can you share an example of how ESG analysis might have influenced an investment?
Yeah, definitely. It is very important. But for us, it's all about attaching ESG back to a financial outcome. It's not, a high level, we don't feel good about this. We need to see that financial impact come through. So there's probably 2 examples that are quite pertinent, I think, particularly in my space. So first of all, Tesla. That for us, we have 4 levels. Level 3, if you're a level 3, then the position size will be constrained. Level 4 means do not invest. Now, Tesla falls into that level 4 category because we can't get comfortable with the governance. Just the dominance of Musk on the board, the fact that he's got all these other interests. You're seeing it now with Doge. You're also seeing it with SpaceX, which is a wonderful business, but that's a diversion away from Tesla. And I think you can see that come through Tesla earnings, where that lack of focus on that business, the car business, the actual core, really is performing quite poorly at the moment. So that's one tangible example. The other would be Meta, that we've been debating really heavily across the team for probably the last 6 months. And the financial linkage there was that after Cambridge Analytica, Apple closed the doors in terms of them being able to follow people around the internet because of privacy concerns. And that meant that it debased the value of their advertising. Now, what they've done is they've managed to rebuild their tech stack and they have got that value of the advertising back. So it's hard to hand on heart say that there is still a material financial impact on Meta from some previous behaviours, and so that has been shifted up to a level 3. So we don't own Meta, but if we did, the position size would be constrained because those governance issues still exist, but the financial impact for them appears to have been largely ameliorated through the business.
Outperformance is so difficult to achieve, but you have. What are the key drivers of your fund's outperformance and how are you positioning the portfolio to deliver continued strong returns in a current market environment that we talked about before is very febrile?
Yeah, no, it is. I think it's the process that has been back tested for decades. It started from a group of guys back in Alliance Bernstein probably about 20 years ago, and now has been running for a couple of decades, and it's proved over time that it can outperform. And that earnings leadership piece is quite important, because what that means is the portfolio isn't anchored as a growth portfolio or a value portfolio. It will change and morph its shape depending on what the market conditions are, which means that you can get more reliability in terms of that long-term performance, not just when there might be a set of conditions that favour the portfolio. So I think that'd be the key thing. The key thing would be that this portfolio will change and will morph according to the conditions in front of it, and that's why it is more of a core all-weather portfolio.
Trent Masters, Global Portfolio Manager at Alphinity Investment Management. Thank you very much for your time.
No, thank you very much for yours.